Hello, fellow Rebel Capitalists. Hope you're well. So, housing data. We haven't discussed the real estate market in at least a month or so, I believe. So, I wanted to dig into the numbers to determine what's happening right now, what has happened in Q4, and then maybe what we can expect with the real estate market and home prices into 2023. So let's check out this article from the New York Times, which surprisingly is actually very good. I think, there's so few things in the United States that aren't politicized, but the housing data isn't yet in that category. Thank goodness. So I think that I briefly scanned this article from the New York Times, and it seems pretty straightforward. There was nothing that insinuated that like Trump or the Republicans were the catalyst to real estate prices going down or something like that. So, title: The housing market is worse than you think. Buyers, sellers, and renters are in for more twists, turns, and soaring mortgage rates, and stubborn inflation signal belt tightening ahead. And I actually had this conversation with Kenny McElroy and Jason Hartman the other night on Jason's channel. And, those are two guys that really have their finger on the pulse of the rental market. Kenny in commercial with all his apartment complexes, and Hartman with the single family, the starter home. Those guys really specialize in those areas. And as of right now, and keep in mind, these guys are specific to geographical locations that are more friendly to landlords and in more linear markets like Texas. Kenny's a lot in Phoenix, but so that would not be a linear market, more cyclical, but it is a market where it's rather landlord friendly. And then Hartman, he likes the Kansas Cities, the Indianapolis, Nashville, and then a lot of those markets that don't go way, way up, that don't go way, way down, hence linear market. But in those types of areas, they said they haven't seen any substantial declines in the rents. Now, they said that the rents are definitely softening. So Kenny, and this was probably last week, he said that he just got off a conference call with all of his property managers saying that when you're doing renewals, let's not do rent bumps. Let's just keep the rents the exact same as they are to make sure that we're able to maximize on our occupancy, because most of these properties Kenny bought a long time ago. So his cost basis relative to the current rents is incredibly, incredibly good. So even if they don't raise rents, it's not really impacting him to a significant degree. Although as a landlord, that's what would be optimal. But you've got to kind of balance your rent increases or the rent you're charging with your occupancy rate. And so again, big takeaway there is that Kenny, who, if you don't know Kenny, he manages about, call it a billion, maybe $1.5 billion in apartment complexes. And I don't know how many doors that is, but it's like, it's like, I remember he told me one time, and it was obviously in the thousands, but I don't know if it's 15,000, 20,000, something like that. I don't know, but it's a lot. So, and they're all apartment complexes. So if anyone's got his finger on the pulse of what is going on right now with rents, it would be Kenny McElroy, at least in those markets. And he's specifically in Arizona, Texas, and then I think he's got a couple properties in Oklahoma City. So he's saying rents are definitely softening. He's not increasing them, but he's not decreasing them as of right now. So this gentleman says, this Stephanos Chen is the guy that wrote this article. Everyone is feeling the squeeze. Mortgage rates sky high, prices sky high. There's no inventory. And this is according to Mark Zandi, chief economist at Moody's Analytics. This may be the worst time in my living history for the home buyer. That's Quote from Mark, it just doesn't make sense. Mortgage rates recently broke 7%. Now they're down a little lower. The highest since 2002, and more than double what most borrowers paid near the start of the pandemic. Between soaring prices, soaring rates, typical, and I would also say a loss of purchase and a decrease in real income. I would throw that in there as well. So you've got soaring prices, soaring rates, and then you've got decreasing real incomes because nominal incomes are going up, but they're not going up at the same rate of inflation. So 77% more on their, okay, so the buyers are having to put 77%. Wow. Let me read this from the start to make sure we're all on the same page and we get this. This is really quite a staggering number. Between soaring prices and rising rates, the typical home buyer in October paid 77% more on their loan per month than they would have last year. Jeez. That's really tough to get your head around. With a national median asking price of $425 and a 10% down payment, that works out to an additional $1,117 every month. And you say, how are people affording this? They're not. It's just there's so few homes for sale and the price is set at the margin. Some contract signings fell for the fourth straight month in September, down 31% compared to September 2021. So the same month, the interest in U.S. housing bubble, as far as Google searches, reached a 15-year high, especially in specific markets like Boise, where the prices have gone up the most. Boise prices went up an eye-popping 51% since September of 2019. They say the days of record low mortgage rates are over, but maybe not. We'll have to see what happens in 2023. If the recession is significant enough, you could see mortgage rates right back to where they were. But in that environment, I would argue it might be pretty difficult to get a loan, very similar to the way it was during the GFC when, sure, interest rates were zero, but not mortgage rates, obviously, but Fed funds. But yet it was very difficult to get a mortgage. To make sense of the current housing market, we spoke with economists, mortgage brokers, real estate agents to plot a course basically as to what housing prices will do in 2023. So they say, how low will prices go? Most analysts don't expect home prices to free fall, but they do expect them to go down. And you say, by how much, George? Well, there were, let's see, in July, they said the first month-on-month price drop since 2019, relatively small decline. But going back to the question of how much are they expected to go down in 2023, as far as the quote-unquote experts, you got Morgan Stanley saying prices will fall 7%. You've got Moody's expects prices to drop 10% from June to the summer. So from June, meaning that was the high water mark last June 2022, to the summer of 2024. But if a recession hits, which is pretty likely, in some supercharged markets like Boise, Phoenix, Moody's predicts prices could drop by more than 30%. And I also want to point out, guys, these numbers they're talking about are nominal prices. So let's just say that prices go down in Boise and Phoenix and some of these other areas where they really went up by a lot, by 30% over the next 2 years, but yet we have, call it 10% inflation. You're basically looking at a 50% drop in real prices when you adjust for inflation. And, one thing I find funny is I always use that chart of home prices adjusted for inflation going back to 1900 that shows where they kind of bottomed out in 2012, which is right at their historic trend line. And since that time, whenever anyone asks me about where I think home prices are going, I always reference that chart. And I say, well, most likely, they're going right back to where they were in 2012. And they always say, oh, George, that's impossible. There's no way that's going to happen. You're crazy. You're out of your mind. Prices will never, ever, ever go back down to where they were until 2012. And I say, yeah, maybe in nominal terms, but you got to adjust for the price of inflation or for the rate of inflation. And when you adjust the nominal prices for inflation, you see that getting back down to those 2012 levels is not that hard. Granted, if we went down 50% from here, we probably still would not be at those 2012 levels, but we'd be getting pretty darn close. And it's not to say that if we go down by 30%, 50% in real terms over the next 2 years, that we can't go down by another 10% or whatever would be required to get back down to that same level that we hit in 2012, which, oh, by the way, was pretty much or very close to the same level we had in the late 90s, which goes all the way back to 1900. Another firm, John Burns Real Estate Consulting, predicted in May when mortgage rates reached 5%, the national home prices would fall by 10% through 2024. But with mortgage rates climbing even higher, the cuts will be deeper, said Rick Palacios Jr., the company's director of research. He echoes the same statements that the guy was talking. I think Mark Zandi was his name at the beginning of the article. He says affordability was the worst it's ever been. And that was before 7% mortgage rates. So now we get into the data, and this is always the push, the kind of the bull pushback that you get, is that we have more people but fewer home sales. And okay, I don't know that directly applies to inventory, or they'll say we have more people but fewer homes, and that is true. But I do think that we can have enough demand destruction to where prices go down even with restricted supply. And they go on to say why there are so few homes available for sale. And here's where they mention this. There is very limited inventory for sale, he said. And because the typical homeowner now has a mortgage rate with low 3.5% interest, few would choose to sell today for fear of facing much higher borrowing costs on the next property. And this is a great argument. And I'm sure this is really at play. But what we have to think through is not everyone's going to have the choice. Like, we're just assuming that going into 2023, that if you own a home right now with a low mortgage, that you're not going to be in a position where you're forced to sell. But I think this is an inaccurate assumption, because if we, right now the unemployment rate's 3.7. Okay, great. What happens in 2023 if we go into a significant recession and the unemployment rate goes up to 5 or 7, 8? I mean, those numbers aren't that high when you look at historical norms. And so we have 8% inflation. We go from 3.7 to 8. That's it. Or unemployment. I say inflation. I'm sorry. I meant unemployment. What does that do to the purchasing power of the people who have these 30-year fixed rate mortgages? And a lot of them will most likely be in a position where they have to sell. And if those prices are set at the margin, again, you can see how we can have a significant supply increase as far as homes for sale, while at the same time, demand is really plummeting. And even if rates go lower, again, it goes back to the fact that money may not be loose, although it is cheap. And in fact, money may be tight. A couple more groups I'd throw in there would be people who have retired and are now living on their investment portfolio. That goes down by 30-40%. They've already taken a massive hit on the bonds, most likely. So, at what point do those retirees have to come back into the workforce or say, you know what? I was going to keep this house, but I've got $250,000 in equity, and I can either sell right now or and try to rent someplace that's way, 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 way smaller, but yet maybe a similar housing payment. Or I can just roll the dice, understanding that 90% of my net worth is tied up in this house. I mean, seriously, put yourself in that position. If I was 75 years old and that was 90% of my net worth, even if I had to, even if I couldn't afford to buy another house because interest rates are so much higher. And again, even if that made me live in a house that was half the size or in a far worse neighborhood, just because I'd have to rent, I'd go ahead and pull the trigger. There's no way that right now, looking at the yield curve and looking what we might get in 2023, that I would risk 90% of my net worth if it was tied up in my home equity. People are in wait and see mode. Right. I agree with this, but I think wait and see mode means that they're right on the edge. Like they're teetering back and forth. Do I sell? Do I not sell? Do I sell? Do I not sell? And once they start to believe the potential home seller or buyer, once they believe that not only will home prices not only are home prices going down, but they will most likely continue to go down, then you get a positive feedback loop where more people sell, home prices go down further. The more home prices go down, the more people that sell and the less demand that you have, and just takes you down very, very quickly. It's a bit like the psychological components of Gresham's law, where if you think your money is losing its purchasing power very, very quickly, and this becomes ingrained in the psyche of society, that's when you really get some serious inflation, potentially hyperinflation, when people are when all the bad money is chasing out the good money. So you're keeping the gold, but you're spending the fiat currency, and that just makes prices like just go completely parabolic. But it's because people are convinced that tomorrow their dollar will be worth a lot less, like way, way less, noticeably less. And it's the same thing with your home equity. If you felt as though by holding on to your house, you were convinced that your house, your nest egg would be worth a lot less, would have a lot less purchasing power, wouldn't you sell right now? So it's at what point in time does that psychology become pervasive throughout society? And this is where you can see the difference in the amount of listings year over year. The listings are up 167% in Phoenix year over year. They're obviously number one. And then it goes down to 0 in St. Louis. And then you've got some where there's fewer listings. Which is weird that they're all in markets where everyone is fleeing. So I think there might be something to that. Maybe it's because so many people were fleeing last year that that now it's just fewer because all the people that were leaving have already left. So, another thing about Phoenix that they're saying is that not just do they have 167% more inventory on the market now than they did a year ago, but they're also leading the United States in home prices or listings where the home prices have been cut. So you list your house for 500, it's not selling. You cut the price down to 450, or you cut the price down to 400. Phoenix is leading the pack in terms of this metric. My goodness. And they say the average discount, the average price drop is nearly 8% or $47,000. So they say that, this is true, that mortgages, historically speaking, aren't that outrageous, but it's really kind of the rate of change. And here's where I got to kind of pick on the author a little bit. So, I mean, it's a great article, but, this is obviously not correct. The spike in mortgage rates has largely been the result of the Federal Reserve raising the rate at which banks lend to each other. Well, I shouldn't say that's totally inaccurate. Yeah, I'd say was far more applicable prior to the GFC. Now with IOR and so many bank reserves, I don't know that they even really need to lend to one another because they're just flushed with reserves. But I guess that could be applicable in some situations. So I won't throw them under the bus for that one. Yeah, the price hikes tend to drive up the Treasury, the 10-year Treasury, which is a close proxy for mortgage rates. And what I would also include is that when they're doing quantitative tightening, they are forcing the market to absorb those mortgages that are being created because the Fed's not there just buying at any price. And the market is saying, okay, well, it's great that you're raising the rate, Fed, but we're going to charge even higher risk premium. So the delta between the Fed funds rate is going to be even higher than it was before, or the delta between the 10-year and what we're willing to accept is going to be even higher than it was before, because we're going to charge a risk premium based on what we think inflation is going to be, where the Fed might not charge that risk premium because they don't worry about a P&L. So then they go on to talk about how the Fed increasing rates and how the 10-year going up has impacted the 30-year fixed rate mortgage and how that impacts the people that are in the market right now. And it's pretty straightforward. What can sellers do? A few months ago, sellers were turning down bids that were $100,000 over asking price. Huh. Wow. They said they're still in shock over how much prices have gone up. The best strategy for sellers is to start at the right price. And, Hartman talks about this all the time. He says that sellers are always looking in the rear view mirror and buyers are always looking directly through the windshield. So if I was a seller, I would, I wouldn't sit there and look around at the comps and say, oh, well, that home across the street sold 6 months ago for XYZ. My home's better than that. So I'm going to charge I'm going to price mine an extra 20 grand or something. I think you'd have to be far more realistic and say, okay, whatever something sold for 6 months ago, unfortunately, I've got to list my property for 10% less in order to move it, because I don't want to get trapped where I'm having to drop my price further and further and further and further and further and further. Kenny was telling me another story about a good buddy of his that just got into kind of the real estate game. And he bought a apartment complex in Seattle, something like this. And he remodeled it, renovation, increased rents, and then was going to go ahead and flip it. And he had a couple $1 million into it. And he was trying to sell it for I don't know what it was. Let's just say 3 million. And he didn't get any offers at 3 million because this was just 3 or 4 months ago when prices started to get soft. And I guess he got an offer for 2.5 or something like that. And keep in mind, he's got roughly 2 million in it, but he's asking 3 million. And so he called up Kenny and he said, "Hey, should I take this offer? You know, it's way below my ask and I wouldn't make that much money, but what do you think?" So Kenny said, "Hey, you know, the market's softening. If it were me, I would go ahead and take it and just kind of run and then just wait to see how the market plays out and then just wait for a better opportunity to make your money on the buy side next time. You know, just keep some dry powder." And what ended up happening is he's like, "Okay, Kenny, you know, I appreciate your advice," but he ended up not taking the offer. He didn't take Kenny's advice. So this, unfortunately, this gentleman now, you know, is in this property for $2 million. You know, he probably borrowed 1 million to do it. So he's got 1 million of his own money, 1 million of the bank's money, and now he probably couldn't sell the property for 1.5. So he's in a very, very difficult position. And that's the position that I would want to avoid being in if I was a homeowner that was dependent upon my current equity for my future standard of living. All right, guys, enjoy the rest of your afternoon. As always, make sure that you're standing up for freedom, liberty, free market capitalism. We'll see you in the next video.